when we look at our investments, the most important part is understand the return on investment. And here we have this formula, how to calculate it. So for somebody who doesn't like math, it's quite maybe overwhelming, you don't like formulas, but basically you have to calculate a percentage of your income versus the amount of money you invested. So if you made $10, it makes a big difference whether you made $10 investing 100 or you made $10 investing 1,000. Yeah, in the first example, you made a very healthy 10%. You made $10 out of 100, so this is a healthy income. In the other case, when you invested 1,000 and you made $10, that's 1%, and that's not so much actually. It doesn't even cover inflation. So you always compare what you earn with how much is invested. And this is what we are going to do from now on. So we are not talking about I made $200, I made 1,000, I made 800. No, we're talking in percentages. Here we have one exercise. If you bought a stock for 100 and you sold it for 150, what is your return on investment? I give you some time. I suggest that you pause the video and calculate it for yourself. And when you finish, you can check the answer. And the answer is, yes, the answer is 50%. I give you another example. I bought a stock for 500. I received $10 of dividend and I sold it for 500. If you don't yet know what is a dividend, well, dividends, some stocks pay dividends. So it's a part of the company profits which you actually receive, which you receive in your pocket. So in this case, you have a stock which is worth 500 and during the year you received $10. It's really went into your pocket. So what is return on investment? Well, return on investment is actually 2%. So the next question I will ask you, which one is better, the first one or the second one? Have a think about it. If necessary, pause the video, think about it, decide which one is better. The answer is you cannot answer this question actually because my question was incomplete. I did not specify the period. Now, we actually don't know if it took you 1 year, 1 month, or I don't know how much, and if the period was the same for the first investment and for the second investment. And so if we don't know the periods, we don't know for sure if the periods are the same, then maybe this is actually, these investments we actually cannot compare. So when we do trading, and let's say the idea of investments we hear about is exactly the first type. Now, when we bought a stock and we sold it and we made a profit. And there, getting a 50% return is possible. There are stocks which offer you 50% return, and it could be even in a short period of time. But the thing is that you might make this profit in a short period of time, but the question is, what will you do with your money afterwards? So if you make one trade, if you earn this money, but then afterwards you don't know what to do with this money and it just sits there, then, well, then during this period you're doing nothing. Your money is not growing. And so then the initial profit you made, you have to calculate it for the period your money was idle afterwards. And actually, if you're doing the trading and if you're buying and selling stocks, the chance is very high, and statistically, very few retail investors are able to play this game for a really long time without making losses. So you might win on some trades and then you will lose on other trades. And then also you have to calculate your return on investment as an average over a long period of time. Well, so in this course, We are not going to talk about trading, and we are not going to learn how to buy and sell single stocks. We are going to learn a method how you can invest your wealth long term in products which are diversified, which are growing long term, and which don't give you work and headache. Which return should you expect? How much do you expect to receive and when? Let's think about it. Imagine you invested 1,000 euro in January 2021. How much should this money be worth a year from that period? What should be an annual return? And this is one thing which is important. You have to set your expectations right. You cannot expect miracles. And when you expect miracles, it's very easy to get into very wrong types of investments. And there are many people out there which are very keen on getting you on their trading platform, promising you sky is the limit. Return investment on various investment assets statistically is this. So stocks give us around 10% annual return long term. If invested long term, 20 years, above 10 years, we can expect 10% return on stocks. And it would be 10% every year. It will be compounding. Next course, we learn what is compounding and what does it mean for your wealth if you invested consistently at this kind of rate. Bonds offer less than 5%, so it's not so much, but again, it's better, much better than nothing. Real estate, with real estate where you rent properties, 5% is considered a good return after all the costs you have and after all the issues you could have with your real estate. And gold statistically long term until now have been given 3%. So it covers inflation. So you will not get rich investing in gold, but it's another way to preserve your wealth. I hope you enjoyed this course. I hope you enjoyed this lesson, and I hope you found it useful.